In a bond auction, there's key auction metrics we want to watch. One is called the bid to cover ratio. The bid to cover ratio is the total bids versus the amount of bonds offered. Now, what's considered a good bid to cover ratio is over 2. In other words, there's twice as much demand as there is bonds being auctioned off. These bid to cover ratios are typically higher for short-term notes than they are for long-term bonds. Then we have what's called the stop out yield. This is the highest yield that's accepted. If there's a spike in the highest yield, in the stop out yield, this signals a funding stress. This is signaling there's a demand problem, and they have to price the bonds at a much higher interest rate to be able to get the demand to get the bonds sold.